Before we begin, it's crucial to state that I am not a financial advisor, and this video is for educational and informational purposes only. The concepts discussed here should not be considered financial, legal, or tax advice. Your financial situation is unique, and you should always consult with a qualified and licensed professional before making any significant decisions regarding your home or finances. You are likely sitting on a secret bank account worth tens, maybe even hundreds of thousands of dollars, and you don't even know it. It's not hidden in a Swiss bank, it's not some forgotten cryptocurrency wallet. It's right under your feet. It's in the walls around you. It's the equity you've built in your home. And for millions of American homeowners, this hidden asset is the key to unlocking major life goals or solving major life problems without having to sell the house you love. Maybe you're staring at a quote for a new kitchen that looks more like a down payment on a second house. Maybe you're juggling high-interest credit card bills that feel like you're trying to run a race in quicksand. Or maybe you're looking at a college acceptance letter for your kid and wondering how on earth you're going to pay for it. These are the moments where you feel stuck. You have this massive asset, your home, but its value feels trapped, inaccessible. This video is your key. By the time you finish watching this presentation, you will have a crystal clear understanding of what a second mortgage is, how it works, and whether it's the right tool for you. We are going to strip away all the confusing bank jargon and financial double talk. I'm going to give you the straight, unfiltered truth so you can make a powerful, informed decision for yourself and your family. This is the definitive guide you've been looking for. So let's start with the absolute basics. What in the world is a second mortgage? The name itself sounds a little intimidating, right? It implies more debt, another payment, another layer of complexity. And while that's partly true, it's missing the entire point. A second mortgage is simply a loan that uses your house as collateral, just like your first mortgage did. The key difference is that it's a second loan, sitting in second position behind your original mortgage. Think of it like this. Imagine your house is a safety deposit box. Your first mortgage lender has the first key. They are first in line to get their money back if you ever sell the house or, in a worst-case scenario, go into foreclosure. A second mortgage lender has the second key. They are second in line. Because they're second in line, the loan is a little riskier for them, which can sometimes affect the interest rates, but it also allows you to tap into your home's value without touching your primary mortgage. This is a huge deal, especially if you locked in a fantastic, low interest rate on your first mortgage a few years ago. You don't want to mess with that. But none of this matters without understanding the fuel that makes this entire engine run. Home equity. Equity is the magic word here. It's the portion of your home that you actually truly own. It's the difference between what your house is worth on the open market today and what you still owe on your mortgage. Let's use a simple example. Let's say you bought your house for $400,000. Over the last few years, you've been making your payments diligently, and the local real estate market has been strong. Today, a real estate appraiser comes by and says your house is now worth $550,000. That's great news. Meanwhile, you've paid down your original mortgage, and you only have $300,000 left to pay. Here's the simple math. Your home's current market value, which is $550,000, minus your outstanding mortgage balance, which is $300,000. The result? $250,000. That $250,000 is your equity. It's your ownership stake. It's that secret bank account we were talking about. A second mortgage is a tool designed specifically to let you borrow against a portion of that $250,000. Lenders won't let you take out the full amount. They need a safety cushion. But they will typically let you borrow up to 80 or 85% of your home's value when combining both your first and second mortgages. That's still a massive amount of accessible cash. So why would anyone do this? Why take on a second loan? The reasons are as varied as the homeowners themselves, but they usually fall into a few key categories of smart financial strategy. The number one reason is home improvement. You use the value of your home to increase the value of your home. Whether it's that dream kitchen, a much-needed bathroom remodel, a new roof, or finishing the basement to create more living space. These aren't just expenses, they are investments back into your primary asset, potentially increasing its sale price down the road. Another huge reason is debt consolidation. Let's be honest, high-interest debt is a wealth killer. Credit cards with 22% interest, personal loans at 15%. They drain your cash flow every single month. A second mortgage often comes with a much lower interest rate because it's a secured loan. It's backed by your house. people will take out a second mortgage to pay off all of those high-interest debts in one fell swoop. Instead of 5 different payments going in 5 different directions, they now have one single lower-interest payment. This can free up hundreds, even thousands of dollars in your monthly budget and give you a clear path to becoming debt-free. Education is another big one. Funding a child's education or even your own is one of the best investments you can make. Tapping into your home equity can be a much cheaper alternative to high-interest student loans. And of course, there are major life events. Starting a business, covering unexpected and expensive medical bills, or even having a large cash reserve for a once-in-a-lifetime opportunity. A second mortgage provides the capital to make these things happen. Now, when you decide to explore this, you'll find that second mortgages generally come in 2 main flavors, and it's critical to know the difference. First, you have the home equity loan, often called a HELOC. This is the straightforward one. You borrow a specific lump sum of money all at once, and you pay it back in fixed monthly installments over a set period like 10, 15, or 20 years. You know exactly what your payment will be every month, and you know exactly when it will be paid off. It's predictable. It's stable. This is perfect for a large, one-time expense like paying for a major renovation where you know the exact cost up front. The second flavor is the home equity line of credit, or HELOC. This one is different. It doesn't give you a lump sum of cash. Instead, it works more like a credit card. The lender approves you for a certain credit limit based on your equity. Let's say they approve you for a $75,000 HELOC. You can then draw money from that line of credit as you need it, up to your limit. You only pay interest on the amount you've actually used. During what's called the draw period, often the first 10 years, you might only be required to pay the interest, making the initial payments very low. It's incredibly flexible, making it ideal for ongoing projects with unpredictable costs, or for use as a powerful emergency fund. So you have the lump sum, predictable home equity loan, and the flexible use-it-as-you-need-it home equity line of credit. 2 powerful tools for 2 different types of needs. But let's pause for a dose of reality. This isn't free money. Tapping into your home's equity is a major financial decision that carries real risk. The single most important thing to remember is that your home is the collateral. If you fail to make the payments on your second mortgage, you could, in a worst-case scenario, lose your home to foreclosure. That's why it is absolutely essential that you go into this with your eyes wide open, with a full understanding of the pros, the cons, the costs, and the commitments involved. And that is exactly what we are going to do together in this series. We've just scratched the surface. Stick with me because we are about to go deep on everything you need to know. We'll break down the exact differences between a HELOC and a HELOC. We'll talk interest rates, fixed versus variable, and how to choose the right one. We'll cover the application process step by step, expose the hidden fees you need to watch out for, and reveal the common, costly mistakes that you absolutely must avoid. This is your masterclass in second mortgages, and it all starts right now. So let's get right to the heart of it. What exactly is a second mortgage? Forget the dense financial jargon for a second. I want you to think about your home in a completely new way. It's not just the place where you live, eat, and sleep. It's a powerful financial asset. It's like a savings account that you've been paying into month after month, year after year with every single mortgage payment. The money in that account is called equity. A second mortgage is simply the key that unlocks that account, allowing you to access the wealth you've built inside the walls of your own home, without having to sell it. It's called a second mortgage because it's a second loan, a second lien, that sits behind your primary one. Your first mortgage gets paid back first if you sell the house. This one comes second. That's why it's also sometimes called a junior lien, because the lender of the second mortgage is in the second position to get their money back. It's a little riskier for them, which can sometimes be reflected in the interest rates. But the crucial part is this. Like your first mortgage, it's a secured loan. And the security is your house itself. This is what makes the interest rates on second mortgages dramatically lower than other types of debt, like credit cards or personal loans, which aren't secured by anything. The bank knows that if worst comes to worst, they have a claim on a real tangible asset, your home. This is a double-edged sword we'll talk more about later. But for now, understand that this security is what gives you access to large sums of money at a much more affordable cost. Now, when you hear second mortgage, you're actually hearing an umbrella term for 2 very different financial tools. Think of them as 2 different flavors of loan, each designed for a specific purpose. These are the home equity loan, often called a HEL, and the home equity line of credit, famously known as a HELOC. Understanding the difference between these 2 isn't just important. It is the single most critical decision you will make in this entire process. Choosing the wrong one can cost you thousands of dollars and create years of financial headaches. Let's start with the home equity loan. The easiest way to think about a home equity loan is as a lump sum payout. It's like walking into the bank, getting approved, and walking out with a briefcase full of cash for the exact amount you borrowed. Let's say you need $60,000 for a major kitchen and bathroom remodel. With a home equity loan, you get that full $60,000 deposited into your bank account all at once, right at the beginning. From that moment on, it works a lot like your primary mortgage or a car loan. You have a fixed interest rate. That rate will never change for the entire life of the loan, whether that's 10, 15, or even 20 years. This means you also have a fixed, predictable monthly payment. You know exactly what you will owe on the first of every month, from the very first payment to the very last. That stability is its superpower. You can budget with absolute certainty. There are no surprises. So, who is the home equity loan for? It's for the person with a single large known expense. You've gotten a quote from a contractor for that $60,000 remodel. You know the exact cost. Or maybe you have $45,000 in high-interest credit card and personal loan debt that you want to consolidate. You know the exact payoff amount. You take the lump sum, pay for the project or pay off the debt, and then you begin making your steady, predictable payments. The pros are clear: stability and predictability. The main drawback? You get all the money at once and you start paying interest on that entire amount from day one, whether you've spent it yet or not. There's less flexibility. It's a one-and-done transaction. Now let's talk about its much more flexible cousin, the home equity line of credit, or HELOC. If the home equity loan is a briefcase of cash, the HELOC is a high-limit credit card, but with a much lower interest rate, and it's tied directly to your home's equity. Instead of giving you a lump sum, a lender approves you for a maximum credit limit. For example, they might approve you for a HELOC of up to $100,000. But here's the key: you don't get any of that money up front. It's just available to you. It's a financial safety net, a reservoir of cash you can tap into as needed. A HELOC operates in two distinct phases. The first is called the draw period, which typically lasts for 10 years. During this time, you can withdraw money from your HELOC as you need it, up to your credit limit. You can write special checks, use a debit card linked to the account, or transfer funds online. If you have a series of college tuition payments coming up over the next 4 years, you can pay for each semester as the bill arrives. If you're doing a home renovation in stages, you can pay contractors as the work is completed. And here's the best part: during the draw period, you only pay interest on the amount of money you've actually used, not the total credit limit. So if you have a $100,000 limit but have only used $20,000, you're only paying interest on that $20,000. For many people, the monthly payments during the draw period are interest only, which keeps them very low and manageable. But, and this is a huge but, unlike the home equity loan, the interest rate on a HELOC is almost always variable. This means it can and will change over time. It's typically tied to a benchmark financial index, like the U.S. prime rate. When the Federal Reserve raises interest rates to fight inflation, the prime rate goes up, and the interest rate on your HELOC will go up with it. Your monthly payment, even if it's interest only, can increase. This lack of predictability is the HELOC's biggest risk. After the draw period ends, say after 10 years, you enter the second phase, the repayment period. At this point, you can no longer borrow any more money from the line of credit. Your account is frozen. You then have to pay back the principal amount you borrowed, plus any future interest, over the remaining term of the loan, which might be another 15 or 20 years. Your monthly payments will now include both principal and interest, so they will be significantly higher than the interest-only payments you might have been making during the draw period. This jump in payment size can be a shock to homeowners who haven't planned for it. So the HELOC is for someone with ongoing, fluctuating, or uncertain expenses. It's for the business owner who needs access to working capital. It's for the parent paying for college over several years. It's an incredible tool for building an emergency fund you don't have to keep in cash. Its superpower is flexibility. Its kryptonite is unpredictability, and the temptation to treat your home equity like an ATM. So, one gives you a stable, predictable lump sum. The other gives you a flexible, variable rate line of credit. Two powerful tools born from the same source, the equity in your home, but designed for completely different jobs. Your choice between them will depend entirely on your specific financial goals, your timeline, and your personal tolerance for risk. There is no single best option. There is only the best option for you. And that brings us to the most important question of all. It's the question that determines whether you can get a briefcase of cash or a financial Swiss Army knife in the first place. It's the question every lender will ask before they even look at your credit score or your income. How much equity do you actually have? And more importantly, how much of it will they actually let you use? Because they won't give you all of it. There's a secret formula, a magic number they use to calculate your borrowing power. In the next part, we are going to pull back the curtain on that exact formula. I will walk you through step by step how to calculate your own usable equity right now so you know exactly how much money you could potentially access. We'll also cover the 3 other critical pillars of approval that make up the lender's secret checklist. Knowing this information before you ever talk to a bank is the key to holding all the cards. Alright, let's unlock the vault. The lender's decision to give you tens, or even hundreds of thousands of dollars, isn't based on a gut feeling. It's a cold, hard calculation based on 4 pillars of approval. Think of it like a 4-legged stool. If one leg is weak, the whole thing gets wobbly. If one is missing, it all comes crashing down. And the most important leg, the one they look at before anything else, is your home's equity. Equity is the simplest, yet most powerful concept in real estate. It's the portion of your home that you actually own free and clear. It's the difference between what your home is worth on the market today and what you still owe on your primary mortgage. So, if your home is appraised at $500,000 and you have $300,000 left on your mortgage, you have $200,000 in equity. That $200,000 is your wealth. It's the pot of gold the second mortgage is designed to tap into. But here's the crucial part. Lenders will never ever let you borrow 100% of that equity. It's just too risky for them. Instead, they use a critical metric called the combined loan-to-value ratio, or CLTV. This number is their safety buffer. Most lenders set their maximum CLTV at around 80 or 85%. This means the total of your first mortgage plus your new second mortgage cannot exceed 85% of your home's current value. Let's run the numbers with our example because this is where you see exactly how much cash you could access. Your home is worth $500,000. The lender's maximum CLTV is 85%. You multiply $500,000 by 0.85, which gives you $425,000. This is the absolute maximum amount of debt the lender is comfortable having against your property. Now, you already have a $300,000 first mortgage. So, you subtract that from the maximum. $425,000 minus $300,000 leaves you with $125,000. That is the maximum amount you could potentially borrow with a second mortgage. It's not the $200,000 in equity you have. It's the $125,000 the bank is willing to lend against it. Understanding CLTV is the first and most important step. If the numbers don't work here, nothing else matters. But let's assume you have plenty of equity. The stool is standing, but now the lender needs to test the other 3 legs. The second pillar is your credit score. This is the lender's trustometer. For a first mortgage, your credit score is important. For a second mortgage, it's paramount. Why? Because of something called lien position. Your first mortgage is in first lien position. This means if, worst case scenario, you default and the house is foreclosed on, they get paid back first from the sale. The second mortgage lender is in second position. They only get paid after the first lender is made whole. This makes their loan inherently riskier. If the home sells for less than expected, they could be left with nothing. To compensate for this risk, they need to know you are a reliable, trustworthy borrower. Your credit score is their best snapshot of that. Generally, you'll need a score of at least 680 to even be considered by most lenders. But the real sweet spot starts around 720 to 740. A score in that range doesn't just increase your chances of approval. It unlocks much better interest rates. The difference between a 680 score and a 760 score could mean saving thousands, or even tens of thousands of dollars in interest over the life of the loan. Before you even think about applying, pull your own credit report. You can do it for free from the official government-authorized site, annualcreditreport.com. Look for errors, old accounts that should be closed, or any surprises. Cleaning up your credit before a lender sees it is one of the smartest financial moves you can make. So, you've got the equity and you've got the credit score. The stool has 2 strong legs. Now for the third pillar, your debt-to-income ratio, or DTI. This is the lender's stress test. They want to know if you can truly afford to take on another monthly payment without being stretched too thin. Your DTI is a simple percentage. It's your total monthly debt payments divided by your total monthly gross income, before taxes. Let's build an example. Say your household brings in $10,000 a month in gross income. Now let's add up all your monthly debts. Your first mortgage payment is $2,500. You have a $500 car payment, and you have minimum credit card payments totaling $200. Your total monthly debt is $3,200. To find your DTI, you divide that debt $3,200 by your income $10,000. That gives you 0.32 or a DTI of 32%. Most lenders want to see a DTI of 43% or less. That's the magic number set by federal regulations for what's considered a qualified mortgage. Some lenders might go as high as 50% if you have a very high credit score and significant savings, but 43% is the standard benchmark. But here's the trick. They don't just look at your current DTI. They calculate your future DTI, including the estimated payment for the new second mortgage you're applying for. So, if you're applying for that $125,000 loan, and the estimated monthly payment is say $900, they add that to your existing debt. Your new total monthly debt becomes $4,100. Now they rerun the calculation. $4,100 divided by your $10,000 income is 0.41, or a new DTI of 41%. Since that's below the 43% threshold, you've passed the stress test. This is why it's so important to not only know your DTI now, but to understand how a new loan will impact it. It's a forward-looking test of your financial stability. And that brings us to the fourth and final pillar, the foundation for everything else, your income and employment stability. It's not just about how much money you make right now. It's about the lender's confidence that you will continue to make that money for years to come. They are looking for proof of stability. The gold standard for lenders is a W-2 employee with at least 2 years of consistent history with the same employer, or at least in the same line of work. A steady paycheck is the easiest thing for an underwriter to verify and approve. If you're self-employed, a freelancer, or a 1099 contractor, you can absolutely still get a second mortgage, but you have to work a little harder to prove your income stability. Instead of pay stubs, you'll need to provide your last 2 years of federal tax returns. The lender will typically average the net income from those 2 years to determine the monthly income they'll use for your DTI calculation. They want to see a consistent or upward trend. A big drop in income from one year to the next is a major red flag. The same goes for other sources of income, like pensions, Social Security, or disability payments. You'll need to provide award letters and bank statements to document that the income is stable and likely to continue. Ultimately, this fourth pillar answers the lender's final question. Is this person's financial life built on a solid foundation or on shifting sand? They need to see a track record of reliability to feel secure in lending you a large sum of money for a decade or more. So there you have it. The 4 pillars of approval. Equity, measured by CLTV. Credit, the measure of your trustworthiness. Debt to income, the stress test of your monthly budget. And finally, income stability, the proof you can sustain those payments long term. If you are strong in all 4 of these areas, you aren't just a hopeful applicant. You are a prime candidate. You are in a position of power. Now that you have the lender's secret checklist, you're in the driver's seat. But getting approved is only half the battle. The next choice you make is arguably even more important. Do you get a home equity loan? Or a home equity line of credit? They sound similar, but one is like a predictable fixed car loan, and the other is like a powerful but potentially dangerous financial credit card tied to your house. In the next part, we'll break down the high-stakes battle between a HELOC and a HELOC, and I'll reveal the one question you must ask yourself to know without a doubt which one is right for you. Alright, let's settle this once and for all. In one corner we have the home equity loan or HELOC, the steady, predictable heavyweight champion. In the other corner, the home equity line of credit or HELOC, the fast, flexible, and sometimes unpredictable challenger. This isn't just financial jargon. This is a decision that can shape your financial future for a decade or more. Choosing the wrong one is like bringing a knife to a gunfight, or worse, bringing a bazooka to a surgical operation. You need the right tool for the right job. Let's start with the champion, the HELOC. Think of a HELOC as a surgical strike. It's a one-time lump sum loan. You apply for a specific amount, say $50,000. If you're approved, the bank cuts you a check or wires you the full $50,000 right then and there. And that's it. The vault is closed. From that moment on, you have a very straightforward, very predictable loan. It almost always comes with a fixed interest rate. That means your monthly payment will be the exact same amount on day one as it is on the very last day of the loan, whether that's in 5, 10, or 15 years. The power of the HELOC is in its absolute rock-solid predictability. You know exactly how much you're getting, you know exactly what your interest rate is, and you know exactly what your payment will be every single month. This is a budgeter's dream. There are no surprises. If the economy goes crazy and interest rates spike to the moon, your HELOC payment doesn't budge. Not 1 cent. You are locked in safe and sound. This stability is its greatest weapon. It's perfect for a single large, well-defined expense. You got a firm quote from a contractor for a $60,000 kitchen remodel? A HELOC is your weapon of choice. You need to consolidate $40,000 of high-interest credit card debt into one manageable payment? A HELOC is designed for exactly that. You know the exact size of the financial mountain you need to conquer, and the HELOC gives you the exact amount of firepower to do it in one clean shot. But every champion has a weakness. The HELOC's weakness is its inflexibility. Once you get that lump sum, that's all you get. What if your $60,000 kitchen remodel suddenly uncovers a major plumbing issue that's going to cost an extra $10,000? Too bad. The HELOC can't help you. You've already gotten your money. You'd have to go find that extra 10 grand somewhere else, or maybe even try to apply for a whole new loan. It's a one-and-done deal. It lacks adaptability. Now let's turn to the challenger, the HELOC. If the HELOC is a surgical strike, the HELOC is like establishing a forward operating base with an open supply line. It's not a lump sum loan. It's a revolving line of credit. The bank approves you for a maximum credit limit, let's say $100,000. But they don't just give you the money. Instead, they give you what is essentially a superpower debit card or a book of checks linked to that $100,000 limit. You can draw money from it whenever you want for whatever you want up to your limit. This is where the HELOC's greatest strength lies. Its incredible flexibility. Let's say you're doing a series of home repairs over the course of a year. The first month you need $5,000 for a new water heater. You take it. Now you have a $95,000 limit remaining. A few months later you need $15,000 for new windows. You take that. You only pay interest on the money you've actually withdrawn. So, in that first month you're only paying interest on $5,000, not the full $100,000. If you don't need any money for 6 months, you pay nothing. It's a financial toolkit you keep on standby. HELOCs are typically structured in 2 phases. The first is the draw period, usually about 10 years. During this time you can borrow and repay money as you please, much like a credit card. Often, your required payments during this phase are interest only, which makes them seem deceptively low. But here comes the danger, the HELOC's glass jaw, the variable interest rate. Unlike the fixed-rate HELOC, the vast majority of HELOCs have a variable interest rate tied to a benchmark, like the U.S. prime rate. When the Federal Reserve raises interest rates to fight inflation, the prime rate goes up, and your HELOC's interest rate goes up right along with it. A rate that was an attractive 5% when you signed up could easily become 8%, 9%, or even higher over the years. Your seemingly low, interest-only payment can suddenly balloon, wrecking your budget. And that's before you even get to the second phase. After the 10-year draw period ends, the HELOC enters the repayment period. Your supply line is cut off. You can no longer borrow money. Now you must pay back the principal plus the interest on whatever balance you have left, typically over a period of 10 to 20 years. This is what we call payment shock. People who were coasting along with low, interest-only payments are suddenly hit with a fully amortized payment that can be double or triple what they were paying before, and it's still at that unpredictable variable rate. It's a financial landmine if you're not prepared for it. So let's put them head to head. HELOC. You get all the cash up front. HELOC. You draw cash as you need it. HELOC. Fixed interest rate, predictable payments. HELOC. Variable interest rate, unpredictable payments. HELOC. Great for a single known expense. HELOC. Great for ongoing unknown expenses. The HELOC is about stability. The HELOC is about flexibility. One gives you peace of mind. The other gives you options. This brings us to the one critical question I promised you. The single question that will cut through all the noise and tell you which path is right for you. Before you talk to a single lender, you need to sit down, be brutally honest with yourself, and answer this. Am I solving a single, known problem? Or am I preparing for a series of unknown challenges? Let that sink in. Your answer to this question is everything. If you say, I am solving a single known problem, you are a HELOC candidate. For example, I have a bill from my daughter's university for exactly $28,000. That is a single known problem. A HELOC will give you exactly the money you need with a payment you can plan for. Or, my contractor has given me a binding quote for $75,000 to build an addition onto my house. Single. Known. Problem. A HELOC locks in your financing so you can focus on the project. But if your answer is, I am preparing for a series of unknown challenges, you are a HELOC candidate. For example, I'm starting a small business and over the next 2 years, I'll have unpredictable costs for inventory, marketing, and equipment. That is a series of unknown challenges. A HELOC gives you the flexibility to access capital exactly when the business needs it, without taking on a massive lump sum debt on day one. Or, we want to remodel our home, but we're doing the work ourselves on weekends. We don't know if it will take 1 year or 3, or how much each phase will cost. Series. Unknown. Challenges. A HELOC lets you pay for materials as you go. It can also serve as a powerful emergency fund, a financial backstop for life's biggest curveballs. Far better than a high-interest credit card. Let's look at 2 families. The Johnsons need to replace their entire roof. They get 3 quotes and the best one is for a firm $22,000. This is a single known problem. They should get a HELOC. They'll get the $22,000, pay the roofer, and then have a simple fixed monthly payment that they can build into their budget for the next 10 years without ever thinking about it again. Now consider the Garcias. Mrs. Garcia is self-employed, and their income can fluctuate. They want a safety net. They also have a list of small projects they want to tackle. Paint the house this year, maybe redo the back patio next year. They don't have firm costs or timelines. They are preparing for a series of unknown challenges. A HELOC is the perfect tool. They can get approved for a $50,000 line of credit and let it sit there, costing them nothing. If the furnace breaks, they can tap it. When they're ready to paint, they can use it. It provides the ultimate financial agility for their lifestyle, as long as they are disciplined and aware of the variable rate risk. Understanding this fundamental difference is the key. Are you funding a project or are you funding a process? Are you paying a bill or are you securing a resource? Now that you know how to choose between these 2 powerful tools, a new set of questions emerges. How do the banks see you? What does it actually take to get approved for one of these? It's not as simple as just having equity. Lenders are scrutinizing you, judging your financial health based on a very specific set of criteria. Getting this wrong can lead to instant rejection. In the next part, we will pull back the curtain on the lender's secret playbook. I'll reveal the 3 pillars of home equity qualification and show you exactly what numbers you need to hit to make the bank see you as a prime candidate, not a risky bet. So, how do you get a lender to roll out the red carpet for you? It's not about luck, and it's not about knowing someone on the inside. It's about understanding their game. When you apply for a second mortgage, a lender is essentially becoming your financial partner. And like any smart investor, they have a rigorous process for deciding who to partner with. They're trying to answer one fundamental question. Will we get our money back? Everything they ask for, every number they crunch, is designed to answer that question. They're looking at your financial life through a microscope, focusing on 3 core pillars that tell them everything they need to know about your level of risk. Master these 3 pillars and you're not just applying for a loan, you're making them an offer they can't refuse. The first pillar is your financial reputation, crystallized into a single 3-digit number, your credit score. This isn't just a number. It's the story of your financial promises. Every on-time payment is a promise kept. Every late payment, a promise broken. To a lender, a high credit score is proof of your character. It says you are reliable, responsible, and you honor your debts. They see you as a safe bet. A low score tells them the opposite story. A history of missed payments, high balances, or defaults. It screams risk. So what's the magic number? While it varies slightly between lenders, the general consensus is that you need a FICO score of at least 680 to be seriously considered. But getting considered is one thing, getting a great deal is another. The real sweet spot, where lenders start seeing you as a prime applicant, begins around 720. Once you cross the 760 threshold, you're in the VIP lounge. At this level, lenders don't just approve you. They compete for your business, offering you their lowest interest rates and most favorable terms. Why? Because a 760-plus score signifies an exceptionally low risk of default. You've proven over years that you are a master of managing credit. But here's the inside secret. Lenders look beyond the score itself. They pull your full credit report and look at the story behind the number. A 700 score for someone who has maintained it for a decade is very different from a 700 score for someone who just recovered from a bankruptcy 2 years ago. They're looking for trends. Is your debt going up or down? Are you consistently opening new lines of credit? They look at your credit utilization, how much of your available credit you're using. If all your credit cards are maxed out, even if you're making minimum payments, it's a massive red flag. It signals financial distress. Ideally, you want to keep your credit utilization below 30% on all your cards. So pillar 1 is simple. Build and protect a strong credit score, because it's the first and most powerful impression you'll ever make on a lender. The second pillar is the bank's skin in the game. This is measured by something called the combined loan-to-value ratio, or CLTV. Now, this sounds complicated, but the concept is incredibly simple. It's a measure of how much of your home's value is being used as collateral for loans. Think of your home's equity as a safety cushion for the lender. If you stop paying and they have to foreclose, that equity is what protects them from losing money. Let's break it down with an easy example. Imagine your home is currently appraised at $500,000. And let's say you have an outstanding balance of $300,000 on your first mortgage. Right now, your loan-to-value, or LTV, is 60%. $300,000 divided by $500,000. This means you have 40% equity, or $200,000 worth of your home that you own free and clear. Now, you want to take out a second mortgage for $75,000 to renovate your kitchen. A lender will calculate your combined loan-to-value. They add your first mortgage balance to the new second mortgage amount. So, $300,000 plus $75,000 equals $375,000. Then they divide that total debt by your home's value. So, $375,000 divided by $500,000 gives you a CLTV of 75%. This number is critical. For most lenders, the absolute maximum CLTV they will consider is 85%. Some might go up to 90%, but those are rare and typically come with much higher interest rates and stricter credit requirements. Why 85%? Because it leaves them with a 15% equity cushion. In a worst-case scenario, if they have to foreclose, they know that even if they have to sell the house at a discount and pay for legal fees, there's still enough money left over to pay off the first mortgage and, most importantly, get their money back. A CLTV of 85% is the line in the sand. Staying below it makes you a viable candidate. Getting your CLTV down to 80% or even 75% makes you a highly attractive one. It tells the lender that you have significant skin in the game, which makes you far less likely to walk away from the property. The third and final pillar is your financial breathing room. This is your debt-to-income ratio, or DTI. If CLTV is about the security of the asset, DTI is about your personal ability to handle the monthly payments. It's a simple calculation. A lender adds up all your monthly debt obligations, your first mortgage payment, car loans, student loans, credit card minimums, and the proposed new second mortgage payment. Then they divide that total by your gross monthly income before taxes. The resulting percentage is your DTI. This number tells a lender how much of your income is already spoken for before you even buy groceries or pay for gas. Let's say your gross monthly income is $10,000. Your first mortgage is $2,000. You have a $500 car payment and $300 in credit card minimums. Your total debt is $2,800. Your DTI is 28%. Now, let's add a new second mortgage payment of $500 a month. Your new total debt is $3,300. Your new DTI is 33%. From a lender's perspective, a low DTI is a sign of financial health. It means you have plenty of cash flow and a buffer to handle unexpected expenses. A high DTI is a major warning sign. It suggests you're living paycheck to paycheck, stretched thin with no room for error. If your car breaks down or you have a medical emergency, you could easily be pushed into a position where you have to choose which bills to pay. So what's the magic number for DTI? For most conventional second mortgage products, the maximum allowable DTI is 43%. This is a hard and fast rule for many lenders, set by underwriting guidelines. Some lenders might be a little more flexible, perhaps stretching to 45% or even 50% if you have an exceptional credit score and a very low CLTV. But you should treat 43% as your absolute ceiling. If you want to be a top-tier applicant, you should aim to be under 40%. A DTI in the low 30s makes you look incredibly financially stable and significantly reduces the lender's perceived risk. These three pillars, credit score, CLTV, and DTI, form the foundation of every lending decision. They don't exist in a vacuum. They work together to paint a complete picture of you as a borrower. A stellar credit score of 800 might convince a lender to be a bit more flexible on your DTI. A huge equity cushion with a CLTV of 60% might make them overlook a slightly bruised credit score in the high 600s. It's a balancing act. The stronger you are in one area, the more it can compensate for a slight weakness in another. The ultimate goal is to be strong in all three. The perfect applicant in a lender's eyes is someone with a 760+ credit score, a CLTV under 80%, and a DTI under 40%. That's the trifecta. A person with those numbers isn't just asking for a loan. They're a low-risk investment that any bank would be eager to make. But what if your numbers aren't perfect? What if your credit score is in the 600s, or your DTI is pushing 45%? Are you just out of luck? Absolutely not. Understanding these pillars is just the first step. The next step is taking action. In the next part, we're going to shift from diagnosis to treatment. I'll give you a step-by-step action plan to turbocharge your qualifications with specific, actionable strategies to boost your credit score, lower your DTI, and present yourself as the ideal candidate lenders are searching for. Alright, let's dive straight into the action plan. Think of this not as a chore, but as a financial boot camp. For the next 30 to 90 days, you are on a mission to transform your financial profile from average to A+. We're going to tackle this in 3 critical stages: the credit score overhaul, the DTI domination, and the perfect borrower profile. First up, the credit score overhaul. Your credit score is the first thing a lender sees. It's their first impression of you, and it's the single biggest factor that determines your interest rate. A few points can be the difference between a good deal and a great deal, saving you thousands, even tens of thousands of dollars over the life of the loan. Your first move is to become a financial detective. Go to annualcreditreport.com. This is the official government-mandated site where you can get your full credit reports from all 3 bureaus, Equifax, Experian, and TransUnion for free. Don't just glance at the score. You need to print these reports out, grab a red pen, and go through them line by line. You are hunting for errors. Is there an old medical bill you already paid? A credit card account that isn't yours? A late payment reported on a month you know you paid on time? One study from the FDC found that 1 in 5 consumers had an error on at least one of their credit reports. If you find an error, dispute it immediately. Each credit bureau has a straightforward online dispute process. This is the lowest hanging fruit for a quick score boost. Next, we attack your credit utilization ratio. This is simply the amount of credit you're using compared to your total available credit. Lenders get nervous when they see maxed out cards. The standard advice is to keep your utilization below 30%. But you're not here for standard advice. To truly turbocharge your score, you want to get that number under 10%. If you have a credit card with a $10,000 limit, that means keeping your balance below $1,000. Pay down your balances aggressively. If you can't pay them all down, try to at least get every single card under that 30% threshold, and your highest limit cards under 10%. Now, how do you pay down that debt strategically? You have 2 famous methods, the avalanche and the snowball. The avalanche method is mathematically superior. You list all your debts from the highest interest rate to the lowest. You make minimum payments on everything, but you throw every extra dollar you have at the debt with the highest interest rate. Once that's paid off, you take all the money you were paying on it and attack the next highest interest debt. The snowball method, popularized by Dave Ramsey, is about psychological wins. You list your debts from the smallest balance to the largest, regardless of interest rate. You attack the smallest debt first with everything you've got. When it's paid off, you get a quick, motivating win, and you roll that payment into the next smallest debt. Which one is better? The one you'll actually stick with. Here's a pro-level tip, the goodwill letter. Let's say you have an otherwise perfect payment history, but you had one late payment a year ago because of a family emergency or a simple mistake. You can write a polite, professional letter to the original creditor, not the credit bureau, explaining the situation and asking for a goodwill adjustment to remove the late payment from your record. It's not guaranteed to work, but you would be shocked at how often it does, especially if you've been a good customer since. It costs you a stamp and 20 minutes of your time for a potentially massive score increase. Finally, a crucial don't. Do not close old credit card accounts, even if you don't use them. A huge part of your score is your average age of accounts. Closing a 10-year-old credit card account makes your credit history look younger, which can hurt your score. It also reduces your total available credit, which instantly increases your credit utilization ratio. So keep them open, maybe use them for a small recurring payment like Netflix, and pay it off in full every month to keep them active. Okay, stage 2. DTI domination. Your debt-to-income ratio is the lender's X-ray into your monthly cash flow. They need to be absolutely certain you can handle another payment. We need to attack this from both sides of the equation: debt and income. On the income side, is there any way to increase it and, more importantly, document it? If you have a side hustle, driving for Uber, freelance writing, selling on Etsy, make sure you are meticulously documenting that income. Lenders typically want to see 2 years of history for self-employment or side income, so start organizing your invoices and bank deposits now. If you're a W-2 employee, are you due for a raise? A conversation with your boss now could result in a higher documented income in a few months. The key is verifiable income. A promise of a bonus doesn't count. A pay stub showing the higher salary does. On the debt side, every single strategy we just discussed for your credit score, paying down balances, consolidating debt, directly helps your DTI. They are two sides of the same coin. But here's the most important rule during this DTI domination phase. Go on a financial lockdown. Do not, under any circumstances, take on new debt. Do not finance a new car. Do not buy new furniture on a store credit card. Don't even apply for a new credit card. Every time you apply for new credit, it dings your score with a hard inquiry, and if approved, increases your total monthly debt obligations. I've seen people with perfect credit get denied for a HELOC because they bought a new truck 2 months before applying, pushing their DTI just over the lender's limit. Don't let that be you. Our third and final stage is crafting the perfect borrower profile. This goes beyond the numbers. Lenders are underwriting a person, not just a spreadsheet. They are looking for stability and reliability. First, employment. Lenders love to see at least 2 years of consistent employment in the same industry, preferably at the same company. If you're thinking about applying for a second mortgage in the next 6 months, it is not the time to make a big career change unless it's a clear and significant step up in pay and responsibility. If you did recently change jobs, be prepared with all your documentation, your offer letter, your first few pay stubs, to show it was a move for the better. Next, get organized. This is your chance to make the underwriter's job so easy that they want to approve you. Create a folder on your computer and start gathering digital copies of everything you'll need. The last 2 years of your W-2s and federal tax returns, your last 2 months of bank statements for all accounts, your last 2 pay stubs, and statements for any investment or retirement accounts. When the lender asks for these documents, you want to be able to send them over within minutes, not spend a week digging through shoeboxes. This portrays you as organized, serious, and on top of your finances. Finally, be prepared to explain any large, unusual deposits in your bank accounts. Lenders have to source all funds to comply with anti-money laundering laws. If your parents gifted you $10,000 for a down payment or to pay off a credit card, you will need a signed gift letter from them stating that the money is a gift and not a loan that needs to be repaid. If you sold a car or got a work bonus, have the bill of sale or the bonus pay stub ready to go. Having this narrative prepared in advance prevents last-minute scrambles and shows the lender that you are a transparent and trustworthy applicant. By systematically overhauling your credit, dominating your DTI, and crafting a perfect borrower profile, you are no longer just a passive applicant hoping for approval. You are an active participant stacking the deck in your favor. You are walking into the negotiation from a position of power. Now that you've transformed yourself into the ideal candidate, the next crucial question is, where do you actually go to get the money? Who do you talk to? Do you walk into the big bank on the corner? Do you call a number you saw on a TV commercial? Or is there a better option? The world of lending is more diverse than you think, and choosing the right type of lender can be just as important as having a great credit score. In our next part, we're going to break down the pros and cons of the 4 main players: the big national banks, your local credit union, the new wave of online lenders, and the one most people forget about, mortgage brokers. And I'll reveal which one often holds the secret to finding the absolute best terms you won't find anywhere else. Let's break them down, starting with the one everyone thinks of first: the big national banks. The Wells Fargos, the Chases, the Bank of Americas of the world. Going to your primary bank feels like the default setting, right? It's comfortable. They have your checking account, maybe your car loan, you know the name, you've seen their ads during the Super Bowl. The biggest pro here is familiarity. You can walk into a branch or log into an app you already use. It feels safe, like ordering the same thing you always get at your favorite restaurant. And sometimes they might offer a relationship discount if you have significant assets with them. But here's the catch, and it's a big one. These banking giants are like massive cruise ships. They are powerful and have immense resources, but they turn slowly and they stick to very specific pre-approved routes. Their underwriting guidelines are often incredibly rigid. They have a box, and if your financial situation doesn't fit perfectly inside that box, maybe you're self-employed, or your debt-to-income ratio is a hair over their limit, the answer is often a flat, computerized no. There's very little room for nuance. You're not a person, you're a file number. And honestly, second mortgages aren't always their favorite product. They make more money on first mortgages and high-interest credit cards. So while they offer them, you may not be getting their A-team or their most competitive rates. It's a product on their shelf, but it might be on the dusty top shelf in the back. Next up, let's talk about their smaller, more community-focused cousin, the local credit union. Think of a credit union not as a bank, but as a financial co-op. It's owned by its members, people like you, and its primary mission isn't to maximize profits for shareholders on Wall Street, but to provide value back to its members. This fundamental difference in structure can translate into some serious benefits for you. Because they are member-focused, they often offer some of the most competitive interest rates and lowest fees on the market. They're not trying to squeeze every last penny out of the transaction. More importantly, credit unions offer a human touch that has become rare. You're more likely to sit down with a loan officer who lives in your town, understands the local housing market, and has the authority to look at your entire financial picture. They do something called portfolio lending, which is a fancy way of saying they often keep the loans they make instead of selling them off. This gives them way more flexibility in their underwriting. If your application is a little unusual, they can actually take the time to understand your story. Maybe you had one bad month 2 years ago that wrecked your credit score, but you've been perfect ever since. A big bank's algorithm sees a number. A credit union loan officer can see a comeback story. The downside? You have to be eligible to join, which usually depends on where you live or work. And their technology might not be as slick as the big bank's multi-million-dollar apps. But for personalized service and great rates, they are a formidable contender. Now let's pivot to the new kid on the block, the online lender. These are the companies you see advertised all over the internet, promising approval in minutes and a hassle-free digital experience. And for many people, they deliver on that promise. Their strength is speed and convenience. They have poured a fortune into creating streamlined, user-friendly platforms that let you upload documents from your phone at 10 p.m. on a Tuesday. Because they don't have the massive overhead of thousands of physical branches and tellers, their operating costs are lower, and they can often pass those savings on to you in the form of very competitive interest rates. They are built for the digital age. But that digital-first approach can also be their biggest weakness. What happens when something goes wrong? When the automated system can't verify your employment, or you have a unique property type that the algorithm doesn't recognize. You're often funneled into a call center, talking to a representative who might be hundreds of miles away, and is just reading from a script. There's no local expert to call, no branch manager to plead your case to. It can be an incredibly frustrating and impersonal experience if your application isn't perfectly straightforward. They are fantastic for the easy loans, but they can become a black hole for anything complex. It's the Amazon of lending. Incredibly efficient until your package gets lost, and then you're stuck in a maze of customer service bots. And that brings us to the fourth option. The one I mentioned is often the secret weapon for savvy homeowners, the mortgage broker. So what exactly is a mortgage broker? This is critical to understand. A mortgage broker is not a lender. They do not have a giant vault of money to lend you. Think of a broker as a professional matchmaker for your finances. They are a licensed intermediary who connects you, the borrower, with a wide array of different lenders. The big bank, the credit union, the online lender, they can only offer you their products. It's like going to a Ford dealership. They're only going to try to sell you a Ford. A mortgage broker, on the other hand, is like an independent auto expert who can take you to the Ford, Toyota, Honda, and Hyundai dealerships to find the absolute best car for your specific needs and budget. Here's why this is such a game changer. First, access. Brokers have relationships with dozens, sometimes hundreds of lenders. This includes the big banks, but more importantly, it includes a vast network of wholesale lenders that you, as a consumer, cannot access directly. These wholesale lenders don't have retail branches or huge advertising budgets. They work exclusively through brokers. And because the broker does all the heavy lifting, finding the client, collecting the paperwork, and packaging the loan, these wholesale lenders can operate with much lower overhead, allowing them to offer incredibly competitive, wholesale interest rates. These are rates you will literally never see advertised to the public. Second, efficiency and protection for your credit. Instead of you spending weeks filling out 5 different applications at 5 different banks, resulting in 5 different hard credit inquiries that damage your score, you fill out one application with the broker. They run your credit once, and then they can shop your single application and credit report to their entire network of lenders to see who comes back with the best offer. It's one-stop shopping at its finest. Third, and this might be the most important part, is expertise and advocacy. A good mortgage broker lives and breathes mortgages. That's all they do. They know the intricate and ever-changing underwriting guidelines of every lender in their network. So, if you're a freelance graphic designer who gets paid with a dozen 1099s, the broker won't waste your time submitting your loan to a bank they know has rigid income requirements. They'll know exactly which 2 or 3 lenders specialize in and welcome self-employed borrowers. They find the right home for your loan. They are on your side of the table. The loan officer at a direct lender works for the lender. The broker works for you. Their job, their reputation, and their future referrals depend on getting you the best possible deal. Now you might be thinking, this sounds great, but how does the broker get paid? Isn't this just another expensive middleman? It's a fair question. Brokers are typically compensated in one of 2 ways. The most common is through what's called lender-paid compensation. In this model, the lender that you ultimately choose pays the broker a commission for bringing them a new qualified customer. This fee is built into the interest rate, but, and this is the key because the broker is accessing lower, wholesale rates to begin with, the final rate you get is very often still lower than what you could have found by going directly to a retail lender yourself. So, even with the broker's compensation included, you still come out ahead. It's a classic win-win. You get an expert guide and a better deal, and they get paid for their service. So when you lay it all out, the picture becomes clear. The big bank offers familiarity but is rigid. The credit union offers a personal touch but has limitations. The online lender offers speed but can be impersonal. The mortgage broker offers access, expertise, and advocacy, effectively combining the best of all worlds by forcing dozens of lenders to compete for your business. For something as significant as a second mortgage, not exploring the broker option is like leaving a huge amount of money on the table. It's the difference between walking into one store and accepting their price versus having a personal shopper who knows where all the secret sales are happening all across town. And once you have that expert on your side, or you've decided to go it alone directly with a lender, the real journey begins. This is where the rubber meets the road. It's the application process, and for many people, it feels like navigating a maze in the dark. But I'm going to turn on the lights for you. We're going to walk through this step by step so you understand not just what you need to do but why you're doing it. Think of your application as the complete story of your financial life. The lender wants to read this story, and they need every chapter to make sense. Your job is to provide the chapters clearly and honestly. The first part of this story is the application form itself, the Uniform Residential Loan Application, or URLA. It's a standardized form and it's going to ask for everything: your name, your social security number, your employment history for the last 2 years, your income, your assets like bank accounts and retirement funds, and your liabilities, which is a fancy word for your debts. This is not the time to be modest or to guess. Be meticulous. If you co-own a car with your cousin, list it. If you have a small personal loan you're paying off, list it. Lenders will find out anyway when they pull your credit report, and any discrepancy between what you wrote and what they find creates a question mark. And in the world of lending, question marks are the enemy of approvals. They create delays and suspicion. Your goal is a story with no plot holes. Once the application is in, the next phase begins: documentation. This is what I call the paper trail. The lender's mantra is trust but verify. They trust what you said on the application, but they need to verify it with official documents. So what do they need to see? First, proof of income. If you're a W-2 employee, this is straightforward. They'll want your most recent pay stubs, usually for the last 30 days, and your W-2 forms from the last 2 years. Why 2 years? They're not just looking at how much you make now, they're looking for stability and consistency. They want to see a reliable pattern of income. If you get bonuses or commissions, they'll want to see a 2-year history of that too, to average it out and make sure it's a dependable part of your earnings. If you're self-employed or a business owner, the story gets a little more complex. You don't have W-2s, so you'll need to provide your personal and business tax returns for the last 2 years. All pages, every single schedule. They'll also likely ask for a year-to-date profit and loss statement, or P&L, for your business. They are trying to build that same picture of stable, predictable income, and for a business owner that just requires more chapters to tell the full story. Next up, assets. They need to see that you have the funds you claim to have. So, you'll provide bank statements usually for the last 2 months for all of your accounts: checking, savings, investment accounts, retirement accounts. Here's a pro tip that can save you a massive headache. Lenders will scrutinize these statements for any large, unusual deposits. A random $5,000 cash deposit a month before you apply looks suspicious. To them, it could be an undisclosed loan from a friend or family member, which is a debt you didn't list on your application. If you have a legitimate large deposit, maybe you sold a car or received a gift, be prepared to document it with a bill of sale or a formal gift letter. The key is to have a paper trail for every significant transaction. After your income and assets are verified, your file moves to the most critical stage: underwriting. The underwriter is the final decision maker. They are the financial detective hired by the lender to examine every piece of evidence in your file. Their job is to assess the risk. They review your credit report in detail, looking at your payment history, your credit utilization, and any public records. They recalculate your debt-to-income ratio using the verified income documents, not just what you stated on the application. They cross-reference everything to ensure your financial story is consistent and sound. If the underwriter has a question, they will issue what's called a condition. This is simply a request for more information or clarification. A missing bank statement page, an explanation for a credit inquiry, or a letter explaining a previous gap in employment. This is where most people get stressed, but it's a normal part of the process. The best thing you can do is respond quickly and thoroughly to any request. The underwriter isn't trying to deny you. They're trying to build a strong enough case to approve you. Help them do their job. Now let's talk about the landmines. These are the common, completely avoidable mistakes that sabotage an otherwise smooth process. Rule number 1: from the day you apply until the day your loan closes, become a financial monk. Your financial life needs to be as stable and boring as possible. Do not, under any circumstances, open new lines of credit. Don't go finance a new car. Don't apply for a new credit card at a department store to save 15%. Don't even buy furniture on a no payments for 12 months plan. Every time you apply for credit, it triggers an inquiry on your credit report, which can slightly lower your score. More importantly, it adds a new monthly debt payment, which changes your debt-to-income ratio. Lenders do a final credit check right before closing, and if they see a new car loan that wasn't there before, it could derail the entire deal at the last minute. I have seen this happen, and it is heartbreaking. Rule number 2: don't change jobs. Just like your income, lenders want to see stability in your employment. Changing jobs, even for a higher salary, introduces a new variable. You'll be on probation, your income structure might change. It creates a new set of question marks for the underwriter right when you want everything to be clear and simple. If you absolutely must change jobs, talk to your loan officer before you do it. Rule number 3: keep your money where it is. Don't make large, unexplained transfers between accounts. Don't deposit large amounts of cash. If your parents are giving you money to help with closing costs, there is a formal process for that involving a gift letter and sourcing the funds. Don't just have them wire you $20,000 out of the blue. Remember the paper trail. Every dollar needs a story. Once the underwriter has verified your financial standing, the final piece of the puzzle is the property itself. The lender needs to know that the collateral for the loan, your home, is worth enough to secure the amount they're lending you. This is where the home appraisal comes in. The lender will order an appraisal from an independent, third-party licensed appraiser. This person has no affiliation with you or the lender. Their job is to provide an unbiased, professional opinion of your home's current market value. They will schedule a visit to your property, where they'll walk through, take measurements, note the condition of the home, its features, and any recent upgrades. Then they will do the real work back at their office. They will find recent sales of comparable homes in your immediate neighborhood. We call these comps. They'll analyze these comps, making adjustments for differences between those homes and yours. For example, if a comp has a brand new kitchen but yours is 15 years old, they'll adjust the value down. If your home has a pool and the comps don't, they'll adjust the value up. The final appraisal report provides a detailed analysis and, most importantly, a final value. This value is critical. Your combined loan-to-value, or CLTV, is based on this number. If you need the appraisal to come in at $500,000 to qualify, but it comes in at $480,000, your loan amount may need to be reduced, or in some cases the loan may not be possible. This is the moment of truth where the bank's risk assessment meets the reality of the housing market. If the value comes in low, you have options. You can challenge the appraisal if there are clear errors, or you can see if the lender is willing to work with the lower value. But preparing for this step is key. It's a reminder that this process isn't just about you and your finances. It's equally about the property that secures the entire transaction. And once that appraisal is settled, you're officially on the home stretch. You've navigated the application, you've proven your financial standing, and your property has passed its own test. Now you're heading towards the final, most crucial stage of the entire process: the closing. This is the finish line. It's where all the paperwork, all the promises, and all the numbers become legally binding reality. For many homeowners, this is the most intimidating part. You're presented with a stack of documents that looks like it could be its own novel, filled with legal jargon and fine print. But understanding this stage is what transforms you from a hopeful applicant into a confident, empowered borrower. The first, and arguably most important, document you'll encounter before you even sit down at the closing table is the Closing Disclosure, or CD. This is a standardized 5-page form, and it is your absolute best friend in this final phase. By federal law, under what's known as the TRID rule, your lender must provide you with this document at least 3 business days before your scheduled closing. This isn't just a suggestion. It's a non-negotiable consumer protection law. This 3-day window is your golden opportunity. It's a mandatory cooling off and review period designed to prevent you from being rushed into signing something you don't fully understand. So, what is this closing disclosure? Think of it as the final detailed invoice and contract summary for your loan, all in one. It spells out in black and white the exact terms and costs of the second mortgage you are about to take on. The numbers on this document should not be a surprise. They should match the loan estimate you received when you first applied. And if they don't, you need to raise a red flag immediately. Let's break down what you need to be looking for. Page 1 is the summary. It gives you the big picture: the loan amount, your interest rate, your exact monthly principal and interest payment, and whether these can change over time. It will also clearly state if there's a prepayment penalty, which we discussed earlier, or a balloon payment. Scrutinize this page. Is the interest rate precisely what you locked in? Is the loan amount correct? A tiny discrepancy here, 1/4 of a percentage point on the interest rate, can translate into thousands of dollars over the life of the loan. This is your moment to catch it. Next, you'll see a section for projected payments. This breaks down your total monthly payment, including principal, interest, and any mortgage insurance if applicable. For a second mortgage, this typically won't include taxes and homeowners insurance, since you're already paying those with your first mortgage, but it's crucial to confirm. Then comes the section that catches most people off guard: the closing costs. This is a detailed, itemized list of every single fee associated with the loan. It's broken down into categories like origination charges, which are the fees your lender charges for creating the loan, and services you did not shop for, like the appraisal fee or a credit report fee. You'll also see costs related to title insurance, government recording charges, and other third-party services. Your job during these 3 days is to review this list line by line. Do the numbers match what you were quoted? Are there any junk fees, any vaguely named processing, or administrative fees that seem inflated? Don't be afraid to question every single charge. Ask your loan officer, what is this for? Why does it cost this much? It's your money, and you have the right to know exactly where it's going. Finally, at the bottom of page 1, you'll see the cash to close calculation. For a home equity loan, this will show the final loan amount minus the closing costs, revealing the exact net proceeds that will be disbursed to you. For a HELOC, it will confirm the total credit line being established. This is the bottom line. This is the number that matters most. Once you've reviewed your closing disclosure and everything looks correct, you're ready for closing day itself. This meeting usually takes place at a title company's office, or with a closing attorney or a mobile notary who might even come to your home. You'll sit down at a table with a closing agent, and they will walk you through that famous stack of paperwork. While it looks like a lot, there are a few key documents that carry the most weight. First is the promissory note. This is as simple as it sounds. It is your promise to pay. It's the IOU. By signing this, you are making a formal, legally binding commitment to repay the loan according to the terms laid out: the amount, the interest rate, the payment schedule. It is the core of your obligation to the lender. Second is the deed of trust, or in some states simply called the mortgage. This is the security instrument. This is the document that links your promissory note to your home. It officially places a lien on your property, giving the lender a security interest. It's the document that says, if I fail to honor the promise I made in the promissory note, the lender has the legal right to foreclose on this property to get their money back. It's what makes this a secured loan. You are literally signing your house over as collateral. Now, here is another incredibly powerful piece of consumer protection that applies specifically to second mortgages on a primary residence. The notice of right to cancel. This is huge. After you have signed every single document at closing, the clock starts on a 3-business-day right of rescission. This means you have a 3-day, no questions asked window to cancel the entire transaction. Maybe you get home and have second thoughts. Maybe you have a sudden case of buyer's remorse, or your financial situation changes unexpectedly. You can notify the lender in writing within those 3 business days, and the loan is canceled as if it never happened. You don't need to give a reason. This is an incredible safety net, and it ensures that you are 100% certain about your decision even after the pressure of the closing appointment is over. Because of this 3-day rescission period, your loan doesn't fund immediately on closing day. The lender will wait until that window has passed. So if you close on a Monday, you'll have Tuesday, Wednesday, and Thursday to cancel. If you don't cancel, your loan will typically fund on Friday, and the money will be sent to your bank account. For a HELOC, this is when the line of credit officially becomes active for you to draw from. Let's quickly touch on paying for those closing costs we saw on the disclosure. You generally have 2 options. You can pay them out of pocket with a cashier's check at closing, which means you receive the full loan amount you applied for. Or, in many cases, you can roll the closing costs into the loan itself. So, if you're taking out a $50,000 loan with $3,000 in closing costs, you could take out a $53,000 loan. You'd receive your $50,000, and the costs would be paid from the loan proceeds. The upside is convenience and no out-of-pocket expense. The downside is that you are now paying interest on those closing costs for the entire term of the loan, making them more expensive in the long run. It's a trade-off between immediate cash flow and long-term cost. With the papers signed and the rescission period over, the money is finally yours. The process is complete. It's a moment of relief and possibility. That renovation project, that debt consolidation, that business investment, it's now within reach. But this isn't the end of the story. In fact, it's the beginning of a whole new chapter in your financial life. The papers are signed, the funds are in your account. But your journey with this new debt is just beginning. How you manage it from here will determine whether it was a brilliant financial tool or a costly mistake. And that's exactly what we're breaking down next. The long-term strategies, the hidden tax benefits, and the pitfalls to avoid after you get the money. So, let's start with strategy number 1, the quarantine account. The moment that money hits your bank, whether it's a lump sum from a home equity loan or the first draw from a HELOC, you need to move it into a separate, dedicated savings account. Do not let it mix with your everyday checking account. This isn't just about organization. It's about psychological discipline. When a large sum of money coexists with your grocery and gas money, it starts to feel like a windfall, feels spendable. And that's how a $50,000 renovation fund suddenly loses $5,000 to a new TV, a few fancy dinners, and some online shopping. By quarantining the funds, you create a mental barrier. That account has one job and one job only: to fund the specific goal you identified. Every dollar that leaves it must be for that purpose. Strategy 2. Immediate execution. The interest on your new loan starts accruing from day 1. Every day you wait to use the money is a day you're paying for a tool you're not using. If you consolidated debt, your first action the very same day should be to log into your credit card accounts and pay them off in full. Don't wait for the paper statement. Get those high-interest balances to zero immediately. If it's for a home renovation, make the initial payment to your contractor so they can order materials and get started. The faster you execute the plan, the more efficient your use of capital becomes. Delay is the enemy of a successful second mortgage. And strategy 3. The new budget reality. Your monthly cash flow has permanently changed. You have a new significant payment to make for the next 10, 15, or even 30 years. You cannot operate on your old budget. You need to sit down and rework your monthly finances to comfortably absorb this new payment. This means accounting for it as a non-negotiable fixed expense, right up there with your first mortgage and utilities. If you can, set up automatic payments from your primary checking account. This automates your discipline and ensures you never miss a payment, which is critical for your credit score and for avoiding late fees. And consider this: can you pay a little extra? Even an additional $50 or $100 a month can have a massive impact, shaving years off the loan term and saving you thousands in interest. Use an online amortization calculator to see the effect. It's one of the most motivating things you can do. Now let's talk about one of the most misunderstood and powerful aspects of a second mortgage: the tax benefits. Many people hear mortgage and immediately think tax deduction, but the reality is far more specific, and the IRS has very strict rules. The ability to deduct the interest you pay on a second mortgage hinges entirely on one question: how did you use the money? According to the IRS, you can only deduct the interest on home equity debt if the funds were used to buy, build, or substantially improve the home that secures the loan. Let me say that again because it is the most important rule you need to know. The money must be used to buy, build, or substantially improve your home. So, if you took out a $100,000 HELOC and used all of it to add a new master suite and remodel your kitchen, congratulations. That interest is generally tax deductible, up to the overall federal limits. The current law allows for interest deduction on a total of $750,000 in qualified mortgage debt for a married couple filing jointly. This includes the combined balance of your first and second mortgages. But here's the trap where so many homeowners get caught. What if you took out that same loan to pay off $20,000 in credit card debt, buy a $30,000 car, and invest the other $50,000? In that scenario, 0% of the interest you pay is tax deductible. Even though the loan is secured by your house, the use of the funds was not for improving the house. This is a critical distinction. Using home equity for debt consolidation can be a brilliant financial move to lower your interest rates. But do not make that move assuming you'll get a tax break on the interest. You won't. This is why record keeping is not just a good idea, it's an absolute necessity. If you ever face an audit, the burden of proof is on you. You need to be able to show the IRS exactly how you spent that money. Keep every single receipt from the hardware store. Keep every invoice from your contractor. Keep copies of cleared checks and bank statements showing transfers to the construction company. Create a folder, digital or physical, labeled Home Improvement Project, and save everything. Without a clean paper trail that connects the loan funds directly to the home improvements, you can't claim the deduction. So, you've got the money, you've got a plan, you understand the tax rules. What can still go wrong? This brings us to the final critical pitfalls to avoid after the deal is done. The first is what I call the reno creep. This is the dangerous cousin of lifestyle creep. Your original plan was a $50,000 kitchen remodel. But now that the money is sitting in your account, you start thinking, while they're at it, we might as well redo the powder room. And those floors in the living room are looking a little worn. And wouldn't a new deck be nice? Each decision seems small in the moment, but they add up. Suddenly, your carefully planned $50,000 project is a $90,000 project, and you're drawing more from your HELOC, or worse, putting the overages on a high-interest credit card, defeating the very purpose of the loan. You must stick to the original plan and budget. Any additions or changes need to be considered with the same rigor and financial analysis as the initial project. The second pitfall is payment shock, especially with a home equity line of credit. Remember, a HELOC often has an initial draw period which can be interest only. Your payments might be incredibly low for the first 5 or 10 years. Feels manageable, easy even. But then the draw period ends, and the repayment period begins. Your payment can suddenly double or even triple overnight, as you now have to pay back both principal and interest, often over a shorter, amortized term. And if interest rates have risen during that time, the shock will be even greater. You have to plan for this from day one. Know exactly when your loan is set to recast, and what the estimated fully amortized payment will be. Start saving or budgeting for that higher payment before it hits. The final and most serious pitfall is complacency. A second mortgage is a marathon, not a sprint. In the beginning, you're focused. You're managing the project, you're paying off the debts. But over time, that second payment just becomes another line item in your budget. You can forget the gravity of what that loan represents. You forget that your home is the collateral. Life happens, a job loss, a medical emergency. And if you haven't built up an emergency fund, that second mortgage payment can quickly become the one that pushes you over the edge. It adds a layer of financial fragility if you're not prepared. Never lose respect for the debt. Continue to prioritize your emergency savings, and always have a plan for what you would do if your income were to suddenly decrease. Because defaulting on a second mortgage carries the same catastrophic consequence as defaulting on the first: foreclosure. The second lien holder can initiate foreclosure proceedings just like the primary lender. Over these 10 parts, we've journeyed through the entire world of second mortgages. We started with the basics, distinguishing a HELOC from a home equity loan. We walked through the complex application process, deciphered the closing costs, and weighed the profound pros and cons. We've explored how to use this tool for everything from renovations to debt consolidation, and discussed the immense responsibility that comes with it. You now have the knowledge that most homeowners don't. You understand that a second mortgage isn't just free money. It is a powerful strategic financial instrument that demands respect, planning, and discipline. It is a lever, and like any lever, it can either help you lift a heavy financial burden and build something incredible, or it can be positioned incorrectly and cause things to come crashing down. The choice of how you use that lever is entirely yours. This knowledge empowers you to look at the equity in your home not as a piggy bank, but as a stored potential. A potential to increase your home's value, to streamline your finances, to invest in your future. So as we close, the final piece of advice is this. Take what you've learned here and apply it to your unique situation. Run the numbers. Be brutally honest with yourself about your discipline and your goals. Talk to a trusted, vetted financial advisor or mortgage professional. Make an informed decision, not an emotional one. Your home is likely the biggest asset you will ever own. It's more than just an investment. It's the center of your life. By leveraging it wisely, thoughtfully, and strategically, you're not just building equity or remodeling a kitchen. You're building a more secure and prosperous future. Now go build it.